A Stock Investment Guide. Chapter 1. Buy a stock to hopefully make money. Basic research on a stock. Before you buy any stock, do the most basic research. Don't just blindly follow what some guy on TV said. At very least, look at the graph, read until you know what it does to earn money, then analyze if you think people are into that right now. What is the intrinsic value of the stock? What is it really worth as a company trying to make money? How does the company make its money? Read the K10 quarterly report. What is its debt? How much money does it owe? If liabilities are more than assets, get out. Look at the balance sheet for cash flow. Check out their competition. How are they doing? Is the stock in a sector that's currently hot or not? Stock Guide 1. There's always a bull market somewhere. Con Artist Joe. The hierarchy of investing is as follows. Low-yielding savings accounts, no-yield checking accounts are safe, but you barely get enough interest to keep up with inflation. Certificate of deposit, CD, accounts offer a bit more yield, but are locked in for periods of 1 to 10 years. Stocks and mutual funds could make a lot of money, but you could lose a lot. Some bonds are safe. Some aren't. If you're worried, buy government savings bonds. Real estate investment used to be safe, but with a glut of foreclosed homes on the market, the real estate business is currently nowhere in most places. People who watch different companies as individual units get a feel for what works over time. That's really the only rule. Look at every company as a holistic unit. Try to figure out what they're doing and where they want to go as you feel it according to the numbers, not as they say it because all corporate reports are hyped up. If you're really into it, you'll go to number 332 at the library and read a bunch of books on the subject. There are a lot of hype books there that offer you their method of buying stocks to make money, but there are also some no-hype, textbook-type stock books that just tell you how the stock market operates without injecting any of their theories into it. You should read at least one of these types of books. You'll read financial magazines, financial newspapers, and the business section of regular newspapers. You'll pick some money websites that you'll visit regularly. For me, money is a means to an end, to have enough to enable me to do what I want in comfort without worrying about it. For a lot of people, money is the scorecard of their lives, their source of power, ego, and identity. These are the type of people who play the stock market because they like the thrill of beating the odds and making money. That's the end for them beyond a certain point where they have enough money for whatever they want. They enjoy the process of playing stocks. It's just another form of gambling. There are a lot of people around like this. If this is you, then you're educating yourself about what's going on in the market every day on your own because you love doing it, and this is the type of person you have to be if you want to score big in the stock market. If you're not this type of person, read a few money magazines at the library to get an idea of the 10 or so great current stocks, buy several of them, put them away and forget about them for 5 years. This is the simplest and sanest way to do it. Securities encompass a broad range of investment instruments including stocks and bonds, mutual funds, options, and municipal bonds. Investment contracts, through which investors pool money into a common enterprise managed for profit by a third party, are also called securities. Securities are bought and sold in a number of different markets. The most popular are the New York Stock Exchange and the American Stock Exchange, but there are 6 other regional exchanges located throughout the country: Boston, Cincinnati, Philadelphia, Spokane, Intermountain, Midwest, as well as the Chicago options market. Securities traded on the exchanges must meet a specified criteria before being listed, which are expanded upon below. The brokers or financial planners who sell stocks must be registered with the National Association of Securities Dealers and one of the self-regulation organizations listed below, whose operations are overseen by the watchdog federal government agency called the Securities and Exchanges Commission, SECONS, SEC.gov. The Securities Exchange Act requires all transactions to be conducted above board under the watchful eye of the SECONS, through which the public has access to all the dealings and information. All companies offering securities for sale are obligated to file what are called a prospectus for each stock or fund they are dealing with. A prospectus is a business statement detailing all the relevant details about the security and must be updated periodically. This seconds is responsible for reviewing these for accuracy, but because it's understaffed, can't righteously do so. Therefore, you must remember that the prospectus of a security could be hyped up and investigate elsewhere by talking to people and reading up on the company. This seconds may find a company is using deceptive practices and charge them criminally. However, you're responsible for reclaiming your losses either through a class action suit with other investors or as an individual, taking them to civil court or arbitration. If you need a lawyer, contact the Public Investors Arbitration Bar Association at 888-621-7484 or 404-365-0150. On an exchange floor, every company has a place where traders can come to buy and sell its shares. The price of the stock depends on the supply and demand of the marketplace, which is supposed to be based on how well the company is doing, but quite often, hype comes in and takes over the market value. Brokers charge a commission fee when selling a stock to an investor. The hierarchy of risks in investing are low. Savings accounts, money market funds, certificates of deposit, CDs. Low middle. Treasury bonds, zero coupon bonds, annuities, municipal bonds. Middle high. Real estate corporate bonds, mutual funds, blue chip/growth/preferred and common stock. High. Options, futures, speculative stock, junk bonds, precious metals, collectibles. Dollar cost averaging is an investment plan where you put in a certain amount up front and a payment every month regardless of how the stock market is doing. This applies to both stocks and mutual funds. Stock Guide 2. Stocks could mean how much money are you willing to lose because it's all risk. Stocks are formed when a company gets big enough that it decides to incorporate and subdivide itself into a bunch of parts called shares or stocks. The company offers to sell these stocks to the public, who then become part owners of the company. Some companies send out dividends to the investors, which are their share of the quarterly profits, while most investors hope to make their profit through the value of the stock rising over time. Shareholders get to vote on company decisions at shareholder meetings, their vote equivalent to the proportion of shares they own. The share values fluctuate depending on how the company is doing at any particular time. You make money from stocks by either buying low and selling high or receiving a share of the annual profits known as dividends. The stock market is a reflection of the economy. It is always growing. You should come to view the market as a live entity fed by the pulse of the nation. The market will speak to you if you stay silent and listen to it. Don't try to outguess it. Respect it. Do what it tells you to do. As long as you invest in more than one company and keep your investments there over several years, chances are you will come out ahead. If you pick the right stocks, you could make a lot of money. The stock can either be all common stock or a combination of common and preferred stock. Common stock is stock where every share has equal value, which is almost always the case with stock sold to investors. Owning any amount of common stock makes you a part owner of the company with a right to vote. The corporation can also add a higher quality of class preferred stocks to the formula, which are special stocks issued to the owners and high executives or other privileged people, giving them a cut of the profits before the balance is dispersed among the common stock. In most cases, preferred stockholders get paid first in the event the company goes bankrupt or closes down, and they generally get a regular dividend which is higher than that of common stockholders. They might also have other special rights, such as the exclusive right to elect X number of directors or something else important in the operation of the company. There are different types of preferred stocks like callable preferred, convertible preferred, cumulative preferred. It can get complicated. Small corporations usually just deal in common stock. The total number of shares owned by investors is called outstanding shares. The most common way to buy stocks for the average investor is to pay full price upon purchase, but for the broker's special clients, people he has known for a while, he might lend them money over and above what they have in their account at a substantial interest rate such that they can buy stocks with this borrowed money. Some common stock terms are: to be long, you own some stock. To be short, you owe the brokerage firm some money, often due to a loss on stocks bought on margin. To be flat means you have a zero balance in your stock account. For your purposes, most of the stocks you buy will over the phone or over the internet at a leisurely pace, but the big institutional buyers and other big timers buy and sell in real time on the New York Stock Exchange trading floor. In order to do business on the floor, you have to have a seat on the exchange and be a member. There is the main floor, a smaller trading floor called the garage, and an even smaller trading room called the blue room. There are a bunch of horseshoe-shaped tables on the floor called trading posts. Every specific stock is traded at a specific location somewhere in the midst of these trading posts. The players react to the fluctuating price of a specific stock by either buying or selling more of that stock, thus changing its price even more. This is what could lead to a frenzy. If the price of a stock starts to nosedive, then everybody who owns it wants to sell it, but if it starts going up, everybody wants to buy it. If a bunch of stocks starts to bomb, it's a panic. The regulators might suspend trading for a while so that hopefully the traders and investors will cool down. There are generally 5 types of members on the NYSE. Floor brokers, execute the orders of public customers. $2 brokers, independent brokers who do trades. Competitive traders, are speculative investors there to make money for themselves. Competitive market makers, they act as brokers when requested to by floor officials or other brokers. Specialists focus on specific stocks and keep the price from fluctuating wildly as it is traded. They provide a fair and orderly market and maintain stability in the stock market. NYSE stocks are sold through 3 systems. The NYSE SuperDot system, electronic trading. NYSE Broker Booth Support System, BBSs, on-the-floor trading. NYSE Online Comparison System, electronic trading in real time for members. Only the most high-profile stocks have a specific spot at a trading post on the floor where they are traded. Most stocks are not traded on the floor. They are traded electronically, either through NASDAQ or OTC, which are basically electronic lists of stocks that are trading. You can look over these lists and decide whether you want to buy or sell some stock based on their past to current performance. There's no physical floor. It's all done in the computer. If you want to buy any specific stock, there is usually one firm that buys and sells that stock. It could be the underwriting firm. It could be someone else. You make the transaction with them. They usually add up to 5% over and above the actual price of the stock as their commission. There are basically 2 types of OTC brokers. 1. Those who are the actual underwriters of the stock. 2. Those who are not the underwriters but have agreed to try to sell some of the stock in an exchange for a commission, so they put it in their inventory of stocks they are selling. Stock Guide 3. There are 2 ways to make money on stocks. Growth, the net asset value of your shares increases. Dividends, the company makes a profit and pays you your share of the profit, something like interest in a savings account, or they could pay out stock dividends where they give you a new share for every X number of shares you already own. This is usually done on a quarterly or annual basis, if at all. Some companies don't pay out dividends. At the library, for stock market investment information, Moody's.com, publishes 6 volumes. Bank and Finance. Industrials. OTC Industrials. Municipals and Governments. Public Utilities. Transportation. Standard & Poor, standardpoor.com, publishes their Standard & Poor's Corporation record made up of 6 volumes. The Value Line Investment Survey is a good weekly report. If you don't understand an investment, don't invest in it. Don't follow the crowd or the bandwagon. Stockbrokers and financial advisors are salespeople. Their job is to make you buy. If you plan to use a financial advisor, find a per hour or flat fee one as opposed to one who works on commission. The best way is to educate yourself and be your own advisor. Get-rich-quick schemes don't work. It is possible that some were good ideas once, but by the time you hear about them, they're old, used up, oversaturated news. If an investment or broker is promising bigger returns than anything else out there, don't invest. It's a con. There are hundreds of books in the number 332 section of the library. I have seen dry textbook type books that get into a detailed analysis of the nuts and bolts way the stock market is run at number 332.642 or HG 4550 at the library. Simplest stock picking method 1. There are 2 times in a man's life when he should not speculate, when he can't afford it and when he can. Mark Twain. Nobody ever saw a dog make a fair and deliberate exchange of one bone for another with another dog. Adam Smith, The Wealth of Nations, 1776. Never invest in anything that eats, needs fuel, or breaks down a lot. Cut your losses short and run your winners long. I get several money magazines and tear out every good article there is, like 10 best stocks, hottest stocks, etc. I put them all in a corner. Then when I get some money and want to buy some stocks, I look through all of them, look for consistent patterns, like if every article picks company X as a hot stock, then I check it out on the internet for the graph for recent performance and read the first few paragraphs of a performance report / corporate filing, then either buy it if the graph is still going up or pass if there's a dip. That's the entire extent of my research. Except for writing this book, stock investing bores me. We all know what the big, stable stocks are that constantly make good gains. If you don't know them, go to the money magazines at the library, look them over for the past year for the articles that talk about the best stocks, write out this list of stocks, look them up on the internet. If the graph is a steady increase for the past 2 years or so, you could do a bit more research, but it's a safe bet to buy it and keep watching it. As long as it keeps going up, hold. If it starts to go down, check out why, then make a decision whether to sell or not. The philosophy is simple. Winners keep winning. Find the winners, buy them and hold until the evidence shows otherwise. On the other side of the coin, if you've got a loser, don't stubbornly hold on it. Don't be emotionally involved in it for the sake of your ego. Let it go. Even though most of the time the articles in money mags are generic, every once in a while they write an article that's worth a fortune in knowledge. Just go to your library, find the money magazines and look through them for the past year to see what you come up with. There are about a dozen of them. The ones I usually read are Kiplinger's Money, Your Money, Smart Money, Money World, Family Money, Ticker, and Morningstar Stock Investor. Business Week and Worth sometimes have good articles. Fortune has a good occasional article called 100 Fastest Growing Companies. Forbes and Inc. basically talk about companies and not specifically about stocks. Standard & Poor's Outlook puts out a master list which ranks companies to buy on a 5-star system. Everybody wants the next Microsoft, which is the little company on the verge of exploding, but the big thing is that nobody knows what will happen. You might see a small company in communications or biotechnology that looks great, but no one knows if 6 months later, it goes bankrupt or explodes. You never know for sure. You have to have a tolerance for risk and loss. At the same time, don't fall prey to hype, especially hype about internet stocks and hype on the internet about anything. Never, ever, ever take a press release for anything at face value. Always dig deeper. The internet by itself is kind of dull. It may never catch on like TV did. I recently saw a company with a big contract with US Sprint. I bought it, then I bought a dry cleaning supplier stock and a home building stock. You have to look for those intuitive gems in stable industries. I don't have the stomach to invest in biotech and possibly lose it all. You can't go wrong with boring and stable like the money business companies and stuff like hardware, food, TV, etc. Good companies usually get better, bad companies may, but don't hold your breath. This means don't look for bargain basement stocks, buy the ones that are currently winning. If you want to play safe, stick with stable, sound companies and don't jump at the current tech craze even if it's spiraling wildly. This is the safe way, but if you have got a strong tolerance for risk, buy and you might win big, but you might also lose big. I watched many internet stocks fizzle in Business 2.0 magazine's analysis of them. Don't go for penny stocks just because they're cheap. Stick with a winning company that has a year or two of proven success. Everybody wants the big winners, so they all get on the bandwagon with current winning stocks, which could be risky because the stocks get overvalued. Don't risk buying IPOs, initial public offerings. Many drop after the initial hype fades. Buy a core few stocks and stick with them. Treat a stock like you treat a company. Is it selling its product out there in the real world? If you don't want to lose sleep, pick several of the mid to large-sized moderate to good gainers over time and stick with them. You probably won't find superstars at NYSE or Amex, but you will find steady eddies there. The big winners are at Nasdaq. I'm generally very suspicious about any OTC stock less than 4 years old. I keep it simple. I have one account with a cheap online brokerage. I look for obscure gems that not everybody knows about. Don't fill your head up with all the garbage spewed out by all the experts. Keep it simple and rely on a few authorities. Investing in stocks is giving a company money and saying to them that you believe that they can help you make money. That's it. So remember, you're looking for a company that has proven they can make money and will continue to do so. I rarely bother with hype because most hyped up companies fizzle after a year or so. Trust the graph. If it's been going up for the past year or two, it's going to continue to keep going up. There are so many companies out there. I don't even bother unless the company has an increasing line on the graph, despite all the crap I hear like restructuring, new markets, expects to take off. If a company works, stick with it. Past performance is the number one criteria. I don't bother much with mega companies like those in the Dow Jones because they're too big for you to make much of a profit, although they're safe if that's your bag. Don't fall into the trap that many do and go all over the place getting dazzled by the overabundance of information out there. I have been there, done that. There's so much info all claiming to be hot tips that the rookie might get excited and start investing in everything. Slow down, take your time, pick a few areas and leave it at that. Stocks are very simple when you get rid of the bull. Stick with the steady, long-time mid-size to large companies and gamble on a few upstarts in emerging fields like computer and other technology. Let someone else do all the work for you. Remember the old line, we're all searching for knowledge and drowning in information. If you want to waste time reading boring books and checking out the internet for a hot tip, go ahead. I already did it and summarized it down for you. There are just a few books that have relevant info like Standard & Poor's Directory of DRIPs, Drip Investor and 100 Best Stocks to Own in America by Gene Walden. I don't pick the good stocks that are currently high profile. I find the good stocks that almost nobody knows about and go with them. Investment News has a list of the top performing 15 financial stocks monthly. Ticker lists America's fastest growing companies. This is a beautiful monthly one-page article which lists 7 winners. Barron's has a good section near the back called the advertising section for late-breaking corporate news. Money covers the winners in their by the numbers market benchmark. Although I like Kiplinger's, overall, my favorite investment newsletters Standard & Poor's Outlook, especially their best performers among star stocks section. Red Herring lists their top 10 of their Tech 250 top gainers. I merely take the ticker symbols of good-looking companies and plug them into a few select websites to get a look at their current and past performance, and that's as good as it gets unless you're an insider. Another thing about me is that I'm simple. I don't pay much attention to P's and all that other stuff, although I know the lower it is, the better. The higher it is, the more overvalued or paper-rich the company is without any real structure backing it up. I just need one look at the chart and I know where it's been and where it's going. The only thing that matters is price, the yearly range and where it's going now. If it's steady or rising slowly, buy because it means it will keep going up. That's as simple as it gets. Beware that despite the fact that insider trading is illegal, all the suits on Wall Street play the manipulation game. They hype their stocks until it's inflated high, then sell while the sucker public is still caught up in the hype, then the stock drops and the sucker public loses. The insiders wait until all the suckers sell, the price is low and the stock is now considered out of favor, although it's still a good company, and they quietly buy shares of this company that's now perceived as a dog. Then it creeps up again until it takes off again. This is a common game with stocks. Stocks to me are a little game I play when I feel like it on the internet. Ameritrade charges about $8 for internet trades, $18 for over the phone. Don't use a full brokerage, they want you to make trades so they get commissions. Simplest stock picking method 2. Use an online trader, make your trades and that's it. I will never trust a stockbroker after what I have been through with some of those guys. They're just like lawyers. By being in the profession, you almost necessarily have to become a scumbag. Stay away, just about all of them are charming phonies. Don't listen to anybody, including all the crap in the chat rooms on the internet. All brokers tell you they're winners but not they're losers, or they just lie straight out and say they bought Microsoft and Dell way back when. There is no system. Education is the only near sure thing. My education is all the publications I get every month, not the dailies or weeklies because they're too boring. The monthlies summarize it all a lot simpler. I comb them all and usually come up with 1 or 2 gems, and that's all you need. I don't waste my time on financial TV. It's too boring and cosmetic. Beyond that, I got a life and it don't waste it on the internet or in one of them investment dailies. I'm out there doing interesting things with my life while all these boring money managers are plodding through their investments on a daily basis. I once knew a few of these guys who I went to college with. Their emotions were tied in with their money. When the stock market lost big, they all got very, very depressed. It was pathetic. When I talked to them, they could barely talk, they were so buzzed out. Right then, I resolved that I'd never end up like them, nothing but stocks day after day after day. A few hours looking at the value line investment survey and a Standard & Poor directory at the library will yield you a few stable, long-time, reasonably sized stocks with a ratings and a good annual rate of return, and that's all you need. If you really want to be lazy, bypass the online or discount brokerage trade and simply choose all drips, refer to drip section. Get Standard & Poor's annual directory of drips, which lists 700 plus companies. It costs about $40 for a very thin book, but it's the lazy man's way out. I go through the list, find the highest yielding stocks and buy directly from them by calling the toll-free number, getting the application and filling it out, sending it back with a check, and that's it. No commissions, no hassles. The lowest common denominator, common sense truth is that the stock market is dull, simple, and boring. Don't waste too much looking for dazzlers in the rough. It's very difficult to find them, and if you find companies that are doing very well on paper, it could be a ploy, scam, or hype simply to sell stock and bail out, so you have to be wary all the time. The most basic rule is that past success over a reasonable amount of time means that the company will continue on being successful. Generally, if comparing successful companies, the smaller ones usually mean more profit for you because they try harder and don't have to spread their profits around as much. I have been through the numbers game extensively and found that it all pales with a common sense look at the company in the real world. The only thing that really matters is earnings per share, profits during the past several quarters and for the past year, that's the bottom line. Don't get messed up and complicated by the numbers game. Keep it simple. Look at a company as a company, not as a series of numbers on a piece of paper. Winners keep winning, losers keep losing. It's okay to look for a bargain in a strong company that's having a bad year, but if a company's been a loser for the past few years, forget it. In a nutshell, look at a stock from all points of view before you buy, both the real-world scenario and the numbers game. Look at highest performing lists. They greatly simplify your work for you. My bottom line best advice is that you rarely go wrong when buying stock in companies that deal in money, like banks, mortgage lenders, and investment companies. Buy some of the big stocks that are in the NYSE and the Dow Jones indexes, then buy a few well-chosen stocks, then a few obscure ones. A rule of thumb is to sell when they double. Many companies often peak and stabilize in 3 to 4 years, but in today's world, some companies run for 15 years straight without letting up. Forget about the stock market as a whole. Invest in individual companies. Don't look at the past of the company. Look at the future. If you find a company that you think is doing better than a stock you own now, sell it and buy the other one. Look for companies who are leaders in growth industries. When the bear hits, the growth stocks get destroyed for a while. You never, ever have complete information about anything in the stock market, which is why you should try to culture allies and share your knowledge with each other. You're all united in a fight with the stock market. The best time to sell a stock is when it's doing great, before it starts to dog out. Some contrarians look for formerly good stocks now in the doghouse. Study them, look at the big picture. Use your instincts. You're betting that the company will turn itself around. Look for a company with an egotistical boss who wants to prove something to the world. It's always about education and knowledge.